Welcome to The Explainer. Today we're going to tear down a real-world business proposal. And this isn't just any proposal. It's a pitch for an investment that makes a promise so huge you almost have to see it to believe it. So let's get right into it.
Okay, let's just start with the hook, the thing that makes you stop and reread the email. Imagine getting a pitch that promises 20% growth, not for the year, but every single month. It's a massive claim, and it's the core promise we're going to unpack, pulled straight from the document itself.
And there's the number, 20%. This is what Stevens Trading Hub, or STH as they call it, puts right up front. It's the engine driving this whole thing. So the obvious question is, how on earth do they claim they can pull this off? Let's see what they say.
All right, first up, let's look at how they actually frame this promise. You know, every pitch has an opening act, and this one is definitely designed to grab an investor by the collar and not let go.
So the proposal's executive summary doesn't beat around the bush. It gets straight to it. The offer is crystal clear. You give them $45,000 and they will aim for 20% growth on that money every month. The stakes are set right from the get-go.
Okay, so that's the promise. But how, right? A claim that big needs a pretty solid explanation. So let's dig into the business model the proposal lays out to try and justify these incredible numbers.
The proposal paints this picture of STH as a high-performance trading firm. They say they operate across a bunch of markets: Forex, commodities, stocks, and crypto. And the magic ingredient? Well, it's their proprietary strategies, which is basically a fancy way of saying they have a secret sauce, a special method that gives them an edge.
And to back all this up, the proposal outlines these 4 pillars. They talk about a proven strategy, solid risk management, transparency for investors, and scalability, meaning they can grow this thing big. These are, all the classic things an investor would want to hear to feel a little more secure.
And here we get a little peek under the hood at one of their methods: algorithmic trading. Put simply, this just means they use computer programs or bots to make trades automatically based on a set of rules. It's a key part of how they claim to operate at high speed.
All right, so we've seen the big promise and the supposed mechanics behind it. Now, for the really important part, let's follow the money. This part of the proposal breaks down the financial nitty-gritty of what would happen to that $45,000 investment.
And here's the breakdown they propose for that 45 grand. The lion's share, 70%, goes directly into trading capital. That's the money they'll actually use to trade. Another 20% is for technology, things like trading bots and software. And the last 10% is to cover their basic operational costs.
Now this is where that 20% promise really comes to life. It shows the power of compounding. So after month 1, a 20% return is 9 grand. But the next month, that 20% is calculated on the new, bigger balance. It's a seriously powerful visual, though of course the proposal has that all-important disclaimer: actual results may vary. One thing the proposal does offer is flexibility in how you structure the deal. You could become an equity partner and own a piece of the company, or go for a profit-sharing agreement for a fixed monthly return, or even use something called convertible debt. It shows they're open to different kinds of partners.
You know the saying, high reward comes with high risk, and any serious proposal has to tackle this head-on. So, what does the document say about the safety net? What are the supposed safeguards here for an investor's money?
The proposal puts forward 4 main safeguards. They claim they'll use diversified portfolios so all the eggs aren't in one basket. They mention automated stop-loss tools that sell automatically if a trade turns bad. And of course, they talk about regulatory compliance and having clear protective contracts for investors. Okay, so here you've got 2 really critical pieces of info side by side. On the one hand, the leadership. They identify a Mr. Stephen Crown as the founder, with over 4 years of experience. And just as important, the exit strategy. The document outlines how you could get your money out, whether through monthly withdrawals, a buyback clause, or selling your stake. So, we've gone through the promise, the plan, the money, and the risks. Let's get to the grand finale. How does this all build to its conclusion? The call to action. What does the proposal actually want the person reading it to do next?
And honestly, I think this quote pulled right from the proposal just sums up the whole vibe perfectly. It's confident, it's direct, it's all about moving forward. The invitation is really clear. If you're a serious investor, the next step is to talk to them, finalize the terms, and get this thing going.
And they lay out that path pretty clearly with these 4 steps. It all starts with a meeting. Then you move to due diligence, that's you doing your homework, and signing an agreement. Then the fund transfer. And finally, the projected monthly payouts begin. They present it as a very clean, straightforward process. So there you have it. We've deconstructed the proposal from Stevens Trading Hub, laying out its claims and its structure, all based on what's in the document. And that brings us to our final thought. See, this explainer isn't about telling you if the claims are true or not, it's about understanding how they're presented. Which leaves us with a really important question for you to think about, not just for this proposal, but for any high-reward pitch you ever come across. What is the very first question you should ask?